You know, there is a specific feeling in the market that is almost impossible to ignore. It's that itch, that fear of missing out when you see a stock chart that looks less like a slope and more like a vertical wall. You look at it and you think, if I don't get in now, I'm never getting in.
The classic FOMO trade. It's the most dangerous emotion on Wall Street.
Exactly. And today we are looking at a textbook example of this scenario. We are diving deep into Coca-Cola Euro-Pacific Partners, ticker CCEP. It is sitting right at its all-time highs, flirting with that psychological $100 mark. The charts look incredible, the brand is legendary, but the data we have from the US Stock Picker podcast channel name US Stock Picker Podcast suggests that if you buy today, you might be walking straight into a trap.
It's a fascinating setup. You have what technical analysts call a blue sky breakout, meaning there is no historical resistance above the current price. It's flying. But, and this is a massive but, the internal mechanics of this rally are screaming exhaustion. We are looking at a report generated on February 15th, 2026, and the message is loud and clear. The trend is bullish, but the timing is terrible.
That's a distinction a lot of people miss. A good company isn't always a good trade right now. So let's break this down. CCEP is trading around $99 to $51. It's broken out of a multi-year base. Why are we telling people to hit the brakes?
Because of the rubber band effect. Imagine a rubber band, you can stretch it and it creates tension. That's momentum. But if you stretch it too far, it has to snap back to the middle before it can stretch again. Right now, CCEP is stretched to the breaking point. The price is currently about 6.7% above its 20-day moving average. Historically, whenever the stock gets more than 5% away from that average, it snaps back. It mean reverts.
So we are statistically overdue for a pullback.
Precisely. And it's not just the moving averages. Look at the RSI, the Relative Strength Index. For CCEP, the daily RSI is sitting at roughly 77. Anything above 70 is considered overbought. An RSI of 77 is the highest reading the stock has seen in over a year. Buying a stock with an RSI of 77 is like trying to sprint the last mile of a marathon at top speed. You just run out of oxygen.
And usually when the RSI gets that high, you see what? A stall, a crash.
Usually a price stall or a 3 to 5% pullback. It needs to cool off. The moving averages need to catch up to the price. And here's the kicker. A, we are 48 hours away from a binary event. Earnings are coming out on February 17th.
Ah, the earnings wildcard. That changes everything.
It does. Buying a stock that is technically overextended 2 days before an earnings report is effectively gambling. It's binary risk. If the report is perfect, maybe you squeeze out another $1 or $2. But if there is even a whisper of bad news, or even if the news is good, but investors decide to take profits, you could see a gap down instantly.
It's the classic buy the rumor, sell the news setup.
Exactly. The report from US Stock Picker Podcast channel name, US Stock Picker Podcast, highlights that while the confidence in the trend is high, 85% bullish for the next few months, the entry quality right now is rated as poor. You are essentially buying the climax of the current leg up.
Let's talk about the bulls versus the bears here, because clearly someone is buying to drive the price this high. What is the bull case? What are they seeing that makes them push the buy button at $99?
The bulls are looking at the blue sky. They see CCEP as a defensive powerhouse. This isn't a speculative tech stock. It's Coca-Cola Euro-Pacific. They see institutional accumulation, volume spikes that suggest big funds are getting in. They argue that $100 is just a psychological speed bump on the way to $115. They believe the momentum is so strong that it will stay overbought for weeks.
Which can happen. Momentum can be irrational.
It can. But the bears have a very strong counter-argument right now. They are pointing at the gap between the current price and the 200-day moving average, which is down at $90 to $32. That is a massive gap for a consumer staple stock. The bears say this move is parabolic, and in the world of staples, parabolic moves almost always correct. Their verdict is, the bulls control the trend, but the bears win on timing.
Bears win on timing. I like that. It means you don't have to short the stock, but you definitely shouldn't be long right this second.
Right. Patience is a strategy. The report explicitly advises a wait signal.
Let's pivot to the fundamentals for a moment. We've talked a lot about the chart, but what about the company itself? Is CCEP actually worth $100 a share?
Fundamentally, it's a mixed bag of great company, expensive price. The fundamental score is 78 out of 100. It's a quality stock. Return on equity is solid at around 18.5%. They have an interest coverage ratio of 11.2x, so their debt is manageable. It's a fortress business model.
But
the valuation is full. The PE ratio is around 25x. That is high for a bottling company. And the PE ratio, price to earnings growth, is 2.61. Typically, a PEG over 2.0 suggests a stock is expensive relative to its growth rate. It's priced for perfection.
And when you are priced for perfection, you cannot afford an imperfect earnings report.
Exactly. Now here's the fascinating disconnect. If you look at the discounted cash flow, or DCF, the theoretical value is nearly $179. So long term, there is massive value. But the market isn't trading on DCF right now. It's trading on momentum and short-term earnings expectations.
So if I'm a long-term investor, I might be salivating at that $179 number. But you're saying I shouldn't let that blind me to the fact that I can probably get it cheaper than $90 next week.
Precisely. Why pay $99 today when the statistical probability says you can likely get it for $96 or $97 in a few days? It's about risk to reward. Right now, the risk-reward ratio is poor, about 0.8 to 1. You're risking more than you stand to gain in the short term.
I want to touch on the institutional activity mentioned in the report. Usually we think of smart money moving in a herd, but here it seems like they are fighting each other.
It's a real tug of war. On one side, you have Exane Asset Management. They just cut their holdings by 35%. That is a massive exit. They sold over 92,000 shares. That tells me they are taking profits at these highs.
That's significant, but who is buying?
Invesco Global Core Equity and Baylard Inc. They are opening new positions, so you have a changing of the guard. One big player thinks it's topped out, another thinks it's a core defensive holding for the long haul. But notice that the selling is coming from an existing holder trimming exposure, while the buying is new money entering.
And analyst ratings, are they screaming buy?
Not screaming. It's a moderate buy. The median target is 107.50. Since we are at 99.50, that implies only about 8% upside. That's not a lot of meat on the bone for a new investor entering right here.
So let's look at the scenario for the next few days. We have earnings on Feb 17. What should our listeners be watching for on the charts?
If you are flat, meaning you don't own it, you do absolutely nothing right now. You sit on your hands, you want to see how the market reacts to the earnings. Ideally, we want to pull back.
What's the magic number? Where does this become a screaming buy again?
The value zone is between 95.50 and 9700.
95.50 to 97. And why there?
That's where the breakout started. It was resistance ceiling, and now it should act as a support floor. It also aligns with the daily moving averages catching up. If price drops to $97, the RSI will cool off from 77 down to maybe 55 or 60. That resets the machine. It gives the stock energy to make the next run higher.
And what if it doesn't drop? What if earnings are amazing and it blows past $100?
Then you look for the high base breakout. If it stays flat between $98 and $100 for a week, just sideways, boring action, that is actually bullish. It allows the moving averages to rise up to meet the price. If it breaks $100.50 after a week of doing nothing, that is a high-quality buy signal. But buying a vertical line, never.
That's great advice. It's counterintuitive to wait when things are exciting, but that's discipline.
Professional traders wait for the dip in an uptrend. Amateurs buy the peak of the candle. CCEP is a strong trend, but a bad entry.
I also noticed the report mentioned the broader market context. The FTSE 100 is volatile, UK GDP is slipping. Does CCEP act as a safe haven in that turmoil?
It usually does. It's a consumer staple. People drink Coke regardless of the GDP. That's why Invesco is buying. But even safe havens get sold off if they get too expensive. Plus, looking at the sector, the consumer staple sector, XLP, is also overbought. If there is a sector rotation, investors moving money out of safety and into tech or growth, CCEP will drop simply because it's in the wrong basket.
So we have sector risk, earnings risk, and valuation risk all converging at the $100 mark.
Exactly. And don't forget the volatility. The VIXY is up slightly. Market fear is creeping in. When fear rises, asset correlations go to 1, meaning everything sells off together. You don't want to be the person buying the top tick before a market-wide correction.
Okay, so for the listeners holding the stock right now, they bought it at $85 or $90. They are sitting on nice gains. Do they sell?
You don't have to sell everything. The trend is still up, but you must protect your profit. The report suggests moving your trailing stop loss to $95.20. That's just below the recent breakout support. If it falls below that, the trend is broken.
And maybe take a little off the table?
Absolutely. If we hit $109.50, selling 25% of your position is prudent. Lock in those wins. You never go broke taking a profit.
Wise words. It seems like the theme for CCEP is patience. It's a great house, but don't buy it when the bidding war is at its peak. Wait for the market to calm down.
That's it. The stock is heading to $105 eventually, probably even $110. But the probability of a $2 to $3 drop happening before we get there is about 70%. Play the probabilities, not the hype.
This has been a fantastic breakdown. It really highlights the difference between liking a company and liking a stock price.
Huge difference, and getting that timing right is what separates the hobbyists from the pros.
Before we wrap up, let's solidify exactly what our listeners should be doing with this information. We've covered a lot of numbers, so let's distill this into a clear action plan.
Sure. Let's break it down into the core essentials.
Okay, let's hit the US Stock Picker Podcast channel name, US Stock Picker Podcast. Final verdict. Here is your call to action for Coca-Cola Euro-Pacific Partners.
First, news sentiment. Analysis. It is moderately positive. The institutional interest is there, and the analyst consensus is a moderate buy. However, the sentiment is fragile due to the binary risk of the upcoming earnings report on February 17th.
Second, fundamental analysis.
Positive score of 78/100. Long-term value is undeniable with a DCF of nearly $179, but short-term valuation is stretched with a P of 25x. It is a great business trading at a premium price.
Third, recommendation of when to start investing.
Do not buy now. You must wait. The ideal time to start investing is after the earnings volatility settles, specifically looking for a pullback or a consolidation period of 5 to 7 days.
Fourth, what price point to start investing at?
Target the value zone between $95.50 and $97. This aligns with the retest of the breakout zone and allows the RSI to cool down to a safer level.
Fifth, when to leave the market.
If you are a short-term trader, you should be looking to exit or trim positions if the price spikes on earnings hype without volume support or if the trend breaks down.
And finally, what price point to leave the market at to mitigate risk?
If you are long, set a trailing stop at 95 juicios. If the price drops below this, the bullish structure is damaged. Conversely, if the price hits $100.50 on a spike, take 25% profit off the table to lock in gains.
Clear, concise, and actionable. Thank you for that deep dive. As always, the market rewards patience and punishes impulse.
Stay disciplined, everyone.
We'll catch you in the next episode.
Disclaimer. The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.